Ed Yardeni just made a surprising admission. Despite being one of Wall Street's biggest bulls for years, he says, "I haven't been bullish enough," and believes the roaring 2020s are still alive and well. In this video, I'll show you the CNBC interview where Yardeni explains why he remains so optimistic about the stock market, the economy, and the impact of the SpaceX IPO. Then I'll break down exactly what he said and give you my own reaction and analysis. Finally, I'll reveal two of the best growth stocks to buy right now based on the trends shaping today's market. Let's hear what Ed Yardeni has to say.
Joining us now to talk what's happening in the broader markets, Ed Yardeni, president of Yardeni Research. Thank you so much for joining us. Good to see you this morning. So it's interesting because you had called, I guess, back in May for a June swoon because you were thinking that perhaps the Fed might hike interest rates in July. Obviously, great news if it holds this morning related to the strait and oil prices. How do you see this as a setup for markets now? And are we clear? June's almost over, but are we clear from a June swoon, and are we clear for more upside in July?
It definitely seems that way. As a matter of fact, we suggested there could be a potential for a June swoon back on June 3rd. On June 5th, the payroll employment came out a lot stronger than expected. Everybody then concluded maybe the Fed's going to move towards a tightening bias, maybe raise interest rates sooner rather than later. But now with the price of oil coming down, with the SpaceX IPO having been done very well, maybe the June swoon is what happened in one day back on June 5th, when the market actually dropped by over 2.5%.
How energizing do you think the SpaceX IPO is for the broader market? I mean, there's one argument that this was going to open the door to Anthropic and AI, and it's just good news for the spirit of the investor. On the other hand, it is just Elon Musk, and he is a particular kind of talent, and he has a particular reach and connection with retail investors. So how do you see that affecting the market?
Well, I'm kind of biased in that regard. I've been talking about the roaring 2020s since August of 2020. It sure feels like the roaring 2020s are here. I mean, this is the seventh year, not the sixth. This is the seventh year of the roaring 2020s. And I've been talking about 10,000 by the end of the decade, by the end of 2029. Now I'm kind of like on my way over here. I was like, what am I going to talk about? Is 10,000 by the end of the decade?
Well, your target, I think, 8250 is your target for the year. Is that still your target? Are you going to increase that target?
Well, I've been among the bulls, and I haven't been bullish enough. I mean, it's really extraordinary. We've been in what I call not a FOMO market, but a FEMO market. FEMO meaning fabulous earnings momentum. Earnings have been unbelievably strong.
Are you surprised by how strong they've been, Ed? Because, and good morning, by the way. It's nice to see you. Futures are soaring. There was a school of thought, and I'm going to bring it a little bit back to energy, that $4, $4.50 a gallon, $5 a gallon gasoline would kill the consumer. Okay, it did not. Not even close. In fact, you look at the MasterCard and Visa data, and I know they track total spending, so as the price goes up, that their numbers are going to go up as well. Zero real indication that impacted the consumer in a negative way. And we're looking at numbers. 20% expected earnings growth for S&P 500 companies for the next 7 quarters, almost 2 full years. It's actually incredible. Are you surprised by how strong it is?
I am, actually. And
me too.
I mean, even during the war in March, the analyst expectations for earnings just kept going up. I said, didn't they get the war memo that there's some trouble going on in the Middle East? And they were right. The economy has weathered that extremely well. That's been one of our theses, is that you just don't want to ignore and underestimate the resilience of the U.S. economy and the U.S. consumer. And I think a lot of that is because of me, people like me, which is a lot of baby boomers. I'm still working for a living, but the baby boomers are retiring with $89 trillion in net worth. We're talking about awesome numbers.
Yeah, and those are the ones with the assets. Those are the investors that have benefited most from this market. When you look at earnings, is there a fear that we are in some kind of earnings bubble? Are those earnings themselves sustainable and repeatable into next year?
Well, I would rather have a earnings-led melt-up than a valuation-led melt-up. So that's what we have right now. So
you're saying because it's not an expansion of multiples, therefore this is a more healthy rally.
Well, when the multiples are going up right now, they're about 20, 21, and they've been kind of stuck there while what's really led the market up is much better, FEMO, much better than expected earnings. There is at some point, you want to be very open to the possibility that there is irrational exuberance about earnings on the part of analysts, that it's kind of feeding on itself. But no, I mean, right now I keep looking at the data. It looks pretty solid.
Does that mean that you think the market is more indifferent to rates? And so, your case for a possible June swoon was based on a July hike.
Yeah.
Regardless of what happens, if inflation is more sticky and rates stay higher for longer,
yeah.
Do you think the market just won't care as much about that? Or how much of an issue or risk are higher rates and sticky inflation going into this year?
Clearly the Fed always has some impact on the market. And its main immediate impact is through the valuation multiple. If people think the Fed's going to tighten, it's going to ease, the immediate impact is on valuation. With a lag, it's going to have an impact on the economy and then on earnings. I think in the current situation, there is everybody's kind of focusing on the fundamentals of the market itself, the resilience of the market. Look, the Fed not too long ago raised the Fed funds rate from basically 0 to 5.5%. Right. And we did have a bear market in 2022, but we didn't have a recession. No. So the bear market didn't last very long. It was a great buying opportunity.
Yeah, and a big reason for that is because we had that huge AI launch at the end that just sparked that huge rally.
Exactly. And look, the SpaceX deal went flawlessly. I mean, it was $75 billion, which is actually a drop in the bucket in the market's market cap, which is something like $75 trillion. So bring it on. We're going to get more IPOs. They're going to be big, and the market looks like it's going to be able to handle it quite well.
One of the first things discussed in the interview is the idea of a potential June swoon. Earlier in the month, Yardeni had warned that stocks could experience a significant pullback. The reasoning seemed logical at the time. Employment data came in much stronger than expected, and investors immediately started worrying that the Federal Reserve might become more aggressive with interest rates. Historically, stronger economic data can sometimes be bad news for stocks because it increases the odds of tighter monetary policy. What's fascinating is how quickly the narrative changed. According to Yardeni, falling oil prices and a successful SpaceX IPO have dramatically improved investor sentiment. Looking back, he suggests that the feared June swoon may have already happened in a single day when the market dropped more than 2.5%. In other words, the correction that investors feared might have already come and gone. I actually think this is one of the most important lessons for investors. The market often punishes people who try to perfectly time every short-term move. A lot of investors spend weeks worrying about a correction only to realize afterward that it lasted a day or two before stocks resumed their upward trend. Markets tend to move ahead of expectations, and by the time the average investor reacts, the opportunity has often disappeared. The conversation then shifts to SpaceX, and this is where Yardeni's long-term bullishness becomes even more apparent. The hosts ask whether the success of the SpaceX IPO is simply an Elon Musk phenomenon, or whether it has broader implications for the market. Yardeni clearly sees it as something much bigger. For years, he has argued that we are living through the roaring 2020s. His thesis is built around innovation, technological advancement, productivity gains, and economic resilience. The successful public debut of SpaceX appears to reinforce that belief. What stands out here is not just the IPO itself, but what it symbolizes. When investors are willing to pour enormous amounts of capital into companies focused on artificial intelligence, space exploration, robotics, and next-generation technologies, it suggests that the market is looking years into the future rather than focusing solely on short-term economic concerns. Personally, I think this is where many people underestimate the significance of these landmark IPOs. It is easy to dismiss them as hype, but major public offerings often signal confidence. They tell entrepreneurs, venture capital firms, and institutional investors that there is still a strong appetite for innovation. That confidence can create a ripple effect throughout the entire market. As the interview continues, Yardeni begins discussing his market targets, and this is where things get really interesting. For a long time, he has been known as one of Wall Street's more optimistic voices. Yet even he admits that the market has outperformed his expectations. He says that despite being bullish, he has not been bullish enough. That is a remarkable statement. Think about that for a moment. Many analysts have spent the past several years warning about crashes, recessions, and economic disasters. Meanwhile, Yardeni is essentially saying that reality has exceeded even his optimistic forecasts. His explanation revolves around what he calls the FEMA market. FEMA stands for Fabulous Earnings Momentum. In Yardeni's view, the market is not rising because investors are blindly bidding up stock prices. Instead, corporate earnings have been much stronger than expected. This distinction matters. There is a huge difference between a market rally driven by speculation and a rally driven by actual business performance. When stock prices rise while earnings remain stagnant, valuations become stretched and risk increases. But when earnings are growing rapidly, stock prices have a stronger fundamental foundation. The hosts point out that analysts are expecting approximately 20% earnings growth for S&P 500 companies over the next several quarters. Those are extraordinary numbers, especially considering all the concerns surrounding inflation, wars, and interest rates. Even Yardeni admits he has been surprised. One of the most striking parts of the interview comes when he reflects on analyst earnings estimates during periods of geopolitical turmoil. During conflict in the Middle East, many expected corporate outlooks to deteriorate. Instead, earnings forecasts continued moving higher. That tells us something very important. The economy is proving far more resilient than many experts expected. And resilience is probably the central theme running throughout this entire interview. Again and again, Yardeni returns to the same point. Investors continue underestimating the strength of the American economy. He specifically highlights the consumer. Many economists predicted that higher gasoline prices would crush spending. The theory seems straightforward. If consumers spend more money filling up their vehicles, they have less money available for everything else. But according to spending data, that collapse never happened. Consumers kept spending, businesses kept generating revenue, corporate earnings kept growing. The expected slowdown never materialized. One explanation Yardeni offers is demographics. He points to baby boomers who are entering retirement with enormous levels of wealth. He mentions approximately $89 trillion in net worth held by this generation. Whether one agrees with the exact figures or not, his broader point is difficult to ignore. There is a substantial amount of wealth sitting in the hands of consumers and investors. That wealth creates a cushion against economic shocks. It helps explain why consumer spending has remained surprisingly strong despite higher interest rates and inflationary pressures. Personally, I think this is an argument that doesn't receive enough attention. A lot of economic commentary focuses on debt levels and affordability challenges, which are certainly real concerns. But wealth matters too. Asset appreciation in stocks, real estate, and retirement accounts has significantly strengthened many household balance sheets over the past decade. The discussion then turns to one of the biggest questions facing investors today. Are we in an earnings bubble? This is a critical issue because if earnings growth proves unsustainable, many of today's bullish forecasts could unravel quickly. Yardeni's response is particularly insightful. He says he would much rather see an earnings-driven melt-up than a valuation-driven melt-up. In simple terms, he would rather see stock prices rising because companies are earning more money rather than because investors are simply willing to pay higher and higher multiples. That distinction is absolutely crucial. Valuation expansion can only go so far. Eventually, investors refuse to pay increasingly expensive prices. But genuine earnings growth can support stock appreciation for years. Yardeni acknowledges that there is always the possibility analysts become too optimistic. Earnings forecasts can become self-reinforcing and eventually detach from reality. However, he emphasizes that the current data still looks solid. That is an important nuance. He is not claiming risk has disappeared. He is simply saying that the evidence today continues to support higher earnings expectations. Another major topic in the interview is interest rates. For years, investors treated every Federal Reserve decision as the most important event in the market. Rate hikes often triggered sell-offs, while hints of easing generated rallies. But the hosts ask whether the market has become somewhat indifferent to rates. Yardeni's answer is interesting because it suggests investors may be shifting their focus. He acknowledges that the Federal Reserve still matters. Changes in interest rates impact valuation multiples and eventually affect economic activity. However, he believes investors are currently paying more attention to fundamentals: strong earnings, strong consumer spending, strong economic resilience. These factors appear to be outweighing concerns about monetary policy. One example he points to is the aggressive tightening cycle that pushed interest rates from near zero to roughly 5.5%. Historically, such a dramatic increase might have caused a severe recession. Instead, the economy avoided a major downturn. There was a bear market in 2022, but the economy continued growing. From Yardeni's perspective, that bear market ultimately became a buying opportunity rather than the beginning of a prolonged economic collapse. I think this is another point worth highlighting because it challenges a common assumption among investors. Many people assume that higher rates automatically lead to disaster, yet the real world is often more complex. The economy consists of millions of consumers and businesses adapting to changing conditions. Sometimes those adaptations are far more effective than economists anticipate. Toward the end of the interview, the conversation circles back to innovation and capital markets. Yardeni notes that the SpaceX IPO raised roughly $75 billion. While that sounds enormous, he points out that it remains relatively small compared to the overall size of the stock market. His message is simple: bring on more IPOs, bring on more innovation, bring on more growth companies. He sees these developments as signs of a healthy and expanding market ecosystem. When you step back and look at the entire interview, the core message becomes clear. Ed Yardeni believes the market is being driven primarily by earnings growth, economic resilience, technological innovation, and consumer strength. He acknowledges risks, including potential over-enthusiasm around earnings expectations, but he does not see evidence that those risks have overwhelmed the fundamentals. His bullishness is rooted in data rather than speculation. Whether you agree with his outlook or not, it is difficult to ignore the consistency of his argument. While many investors continue searching for the next recession, Yardeni remains focused on what is actually happening in front of him: strong earnings, resilient consumers, expanding innovation, and a market that continues finding reasons to climb higher. And perhaps the biggest takeaway from this entire discussion is that markets often reward those who focus on long-term trends rather than short-term fears. Every year brings a new list of reasons to be worried. Yet throughout this decade, the economy has repeatedly demonstrated an ability to adapt, recover, and move forward. According to Ed Yardeni, that story is far from over, and if he's right, the roaring 2020s may still have plenty of room left to run. Now let's dive in and break down two of the best growth stocks to buy right now that could potentially reward investors for years to come. Let's start with the first company on the list, Uber Technologies, ticker symbol UBER. When most people think about Uber, they think about ordering a ride from their phone. But if that's all you think Uber is, you're probably missing the bigger picture. The real investment thesis behind Uber is not about ride-sharing, it's about becoming a critical transportation and logistics platform that sits at the center of how people and goods move around the world. And that distinction matters. The strongest businesses in history are often platform businesses. They create ecosystems where users, suppliers, and partners all interact through a single network. Once those networks become large enough, they become incredibly difficult to disrupt. Uber has spent years building exactly that kind of network. Every day, millions of riders open the app. Millions of drivers rely on the platform. Businesses use Uber's delivery infrastructure. Restaurants depend on its customer reach. Consumers have integrated Uber into their daily lives. What makes this powerful is that every additional user increases the value of the network. The more riders there are, the more attractive the platform becomes for drivers. The more drivers there are, the faster and more reliable the service becomes for riders. The more restaurants join, the more attractive the platform becomes for customers. This creates a self-reinforcing cycle that gives Uber a significant competitive advantage. And unlike many technology companies that are still trying to figure out how to make money, Uber has already crossed an important threshold. The company is generating massive profits. Last year, Uber generated approximately $52 billion in revenue. Even more impressive, more than $10 billion flowed to the bottom line. Think about that for a moment. There was a time when many investors viewed Uber as a company that would always prioritize growth over profitability. Critics argued that the business model would never generate meaningful earnings. Today, those arguments look increasingly outdated. Uber has proven that it can scale globally while also producing significant profits. That combination is incredibly powerful, because once a company reaches profitability at scale, management gains flexibility. They can invest in expansion, they can improve technology, they can strengthen their balance sheet, they can return capital to shareholders in the future, and they can pursue opportunities that smaller competitors simply cannot afford. One reason I find Uber particularly interesting right now is because many investors seem focused on short-term stock performance rather than long-term business performance. The stock is down roughly 10% this year. For many investors, that decline creates concern. For long-term investors, it may create opportunity. After all, the stock has risen around 50% over the past 5 years despite numerous economic challenges, inflation concerns, and changing market conditions. Currently, shares trade around $74, not far above their 52-week low of just over $67. When great businesses experience temporary weakness, smart investors often start paying attention, because successful investing isn't usually about buying what's already popular. It's often about identifying quality companies before the market fully appreciates their future potential. And speaking of future potential, this is where the Uber story gets particularly exciting. One of the most talked about trends in transportation today is autonomous driving. Many investors immediately assume autonomous vehicles are a threat to Uber. But what if they're actually an opportunity? Think about it. Even if robo-taxis become widespread, consumers will still need a platform to connect them with those vehicles. They'll still need an app. They'll still need payment systems. They'll still need customer support. They'll still need route optimization. They'll still need a trusted platform that manages the entire experience. Uber already has all of those pieces in place. In fact, Uber may be uniquely positioned to benefit from autonomous transportation because it already controls one of the largest transportation marketplaces in the world. Instead of owning fleets of vehicles, Uber can potentially become the operating system that connects riders to whatever transportation option is available. Human-driven vehicles, robo-taxis, autonomous delivery services, and potentially transportation solutions that haven't even been developed yet. This flexibility is one of Uber's greatest strengths. The company doesn't necessarily need to win the autonomous vehicle race itself. It simply needs to remain the platform consumers choose when they want transportation. That's a very different investment thesis than many people realize. Another reason Uber deserves attention is its international growth potential. Despite its enormous size, many global markets remain underpenetrated. Urbanization continues to increase around the world. More people are moving into cities. More consumers are becoming comfortable using digital services. More economies are adopting mobile payment solutions. These trends create long-term tailwinds that could support Uber's growth for years. And because Uber already has experience operating across numerous countries and regulatory environments, it enters new markets with valuable expertise. Scale matters. Brand recognition matters. Technology infrastructure matters. Uber possesses all three. Now let's talk valuation. One of the biggest mistakes investors make is focusing exclusively on growth while ignoring price. Even the greatest company can become a poor investment if purchased at an unreasonable valuation. That's why Uber's current valuation is worth discussing. The stock currently trades at approximately 18 times earnings. Among the companies featured in this video, it is the cheapest based on earnings multiple. That should immediately catch the attention of value-oriented growth investors. Because normally investors expect to pay premium valuations for businesses with strong growth prospects. Yet Uber offers an unusual combination. You get a company generating tens of billions in revenue. You get strong profitability. You get exposure to transportation technology. You get international expansion opportunities. You get potential upside from autonomous vehicle adoption. And you're getting all of that at a valuation that looks relatively modest compared to many growth stocks. Now that doesn't mean Uber is risk-free. No investment is. Competition remains intense. Regulatory challenges will continue to exist. Economic slowdowns can impact consumer spending patterns. Changes in labor regulations could affect operating costs. Investors should always acknowledge risks, but the key question is whether those risks are already reflected in the stock price. And that's where the investment case becomes compelling, because when you look at the business fundamentals, Uber appears stronger than ever. Revenue remains massive. Profitability has improved dramatically. The network effect remains powerful. Growth opportunities remain substantial, and the valuation appears reasonable. Those are characteristics that long-term investors should pay attention to. Another factor worth considering is how Uber fits into broader economic trends. Many businesses are being disrupted by technology. Uber is one of the disruptors. Consumers increasingly expect convenience. They want services available instantly. They want transactions completed through their phones. They want friction removed from everyday activities. Uber directly benefits from those behavioral shifts. Every year, digital adoption increases. Every year, consumers become more comfortable with app-based services. Every year, transportation becomes more integrated with technology. These trends aren't temporary, they're structural. And structural trends often create some of the biggest investment opportunities. What's especially impressive is how Uber has evolved from a single-purpose application into a broader ecosystem. The company is no longer simply helping people get from point A to point B. It's helping people move, shop, order food, and access services through one integrated platform. That creates multiple growth engines under one corporate umbrella. If one segment slows temporarily, another segment can help support overall growth. Diversification inside a single business is often overlooked by investors, yet it can significantly strengthen long-term performance. Looking ahead over the next 5 to 10 years, I believe the most important question investors should ask is this: will transportation and logistics become more digital or less digital? The answer seems obvious. Everything points toward greater digitization, more connectivity, more automation, more convenience, more reliance on technology platforms. If that's the future, then Uber remains positioned at the center of a powerful long-term trend. That's why I believe Uber Technologies deserves serious consideration from growth investors today. The stock isn't perfect. No stock is. But when you combine its scale, profitability, network effects, growth opportunities, and attractive valuation, it's not difficult to understand why many investors view Uber as one of the most compelling growth opportunities available right now, and in my opinion the market may still be underestimating just how valuable Uber's platform could become over the next decade. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second and final stock on the list is Robinhood Markets, ticker symbol HOOD. This is probably one of the most misunderstood growth stocks in the market today. When many investors hear the name Robinhood, they immediately think about meme stocks, day traders, and the speculative frenzy that dominated headlines a few years ago. But if that's still how you're viewing Robinhood, you may be missing the much bigger investment story. Because the real opportunity here isn't about meme stocks, it's about financial relationships. And more specifically, it's about capturing customers at the beginning of their investing journey and potentially keeping them for decades. Think about the economics of that. Most financial institutions spend enormous amounts of money trying to acquire customers. Robinhood has built a brand that naturally attracts younger investors. For millions of people, Robinhood is the very first platform they use when they buy their first stock. That creates a powerful advantage. The average age of Robinhood users has historically been younger than customers at many traditional financial institutions. Why is that important? Because investing is often a lifelong activity. A 25-year-old investor today could still be actively investing 40 years from now. If Robinhood successfully retains those customers and expands the services it offers, the lifetime value of each customer could be enormous. This is one of the reasons why I think many investors underestimate Robinhood's long-term potential. They're focused on what the company is today. Smart investors should also focus on what the company could become. And Robinhood is clearly trying to become much more than a simple stock trading app. Today, users can buy and sell stocks. They can trade cryptocurrencies. They can access various investing products. The company has also expanded into prediction markets and continues exploring additional financial services opportunities. The bigger vision appears to be creating a comprehensive financial platform where users can manage much of their financial lives in one place. If management successfully executes that vision, Robinhood could become one of the most important financial technology platforms of the next decade. And that's exactly why growth investors continue paying close attention to this stock despite recent volatility. Now let's talk about the stock itself. Robinhood shares have struggled this year. The stock is down approximately 15% and trades just below $100. For some investors, that decline may seem concerning, but long-term investors often view pullbacks differently. A declining stock price doesn't automatically mean a declining business. Sometimes the market becomes overly focused on short-term challenges while ignoring long-term opportunities. That's where careful analysis becomes important. One of the biggest challenges Robinhood has faced recently involves cryptocurrency markets. Crypto activity tends to have a major impact on trading volumes. When crypto enthusiasm rises, user engagement often increases. When crypto markets cool off, trading activity can decline. That creates fluctuations in revenue growth, and that's exactly what investors have been watching. However, focusing only on short-term crypto cycles can distract from a much larger story. The company's growth over the past few years has been remarkable. Back in 2022, Robinhood generated approximately $1.4 billion in annual sales. Fast forward to today, and the company has generated roughly $4.6 billion over the past 4 quarters. Just think about that growth trajectory. Revenue has more than tripled in only a few years. Very few companies achieve that level of expansion, and what's even more impressive is that Robinhood is no longer simply pursuing growth at any cost. The company is profitable. That matters a lot. Investors often become excited about rapidly growing businesses, but growth alone isn't enough. Eventually, businesses must prove they can generate sustainable profits. Robinhood has reached that stage. The company is demonstrating that it can grow while also producing earnings. Whenever a growth company successfully makes that transition, investors should take notice. Because profitability creates options. It allows management to invest in new products, it strengthens the balance sheet, It improves resilience during economic downturns, and it provides flexibility for future expansion. Another reason Robinhood remains interesting is the broader trend towards self-directed investing. Younger generations are increasingly taking control of their financial futures. They're learning about investing earlier. They're managing their own portfolios. They're exploring alternative asset classes. They're becoming more comfortable using digital platforms rather than relying exclusively on traditional financial advisors. Robinhood sits directly at the center of that trend, and trends like these often play out over decades, not years. Technology has transformed transportation. Technology has transformed communication. Technology has transformed entertainment. Financial services are undergoing a similar transformation. Consumers increasingly expect financial products to be simple, mobile, and accessible. Robinhood was built specifically for that environment. Its mobile-first approach resonates with a generation that manages much of life through smartphones. That user experience advantage should not be underestimated. Convenience matters, accessibility matters, user engagement matters, and Robinhood has invested heavily in all three. Now let's discuss what may be the company's most valuable asset: its customer base. Financial businesses often become stronger over time because customer relationships compound. Once someone trusts a platform with their investments, they're more likely to use additional products offered by that same platform. This creates opportunities for cross-selling. A customer who starts with stock trading may later use retirement products. Another customer may become interested in cryptocurrency. Someone else may explore prediction markets. Each additional service deepens the customer relationship, and deeper relationships generally translate into higher long-term value. This is one reason why financial platforms can become incredibly powerful businesses. They benefit from both customer growth and customer engagement. Robinhood appears focused on improving both. Of course, investors should acknowledge risks. Competition remains intense. Financial regulations can change. Trading activity can fluctuate. Crypto markets remain volatile, and investor sentiment can shift rapidly. These factors create uncertainty, but uncertainty is often where opportunities emerge. The market rarely offers attractive prices when everything looks perfect. Sometimes the best investments are found when investors are focused on temporary concerns rather than long-term fundamentals. Let's also discuss valuation. Robinhood currently trades at approximately 46 times trailing earnings. That valuation is certainly higher than Uber's. There is no denying that. At first glance, some investors may immediately conclude the stock is expensive, but valuation should always be viewed in context. The key question isn't whether a stock looks expensive today. The key question is whether future growth justifies the current valuation. Robinhood's supporters would argue that it does. After all, we're talking about a company that has grown revenue from $1.4 billion to roughly $4.6 billion in a relatively short period. We're talking about a company targeting large and expanding financial markets. We're talking about a company serving younger customers who could remain active users for decades. Those factors can support premium valuations, especially when growth remains strong. Personally, what I find most compelling about Robinhood is its optionality. Many investors try to value the company based solely on what it currently offers, but the bigger opportunity may come from products and services that don't yet contribute meaningfully to revenue. The company continues expanding. It continues innovating, and it continues searching for ways to increase engagement within its ecosystem. If management executes successfully, today's Robinhood could look very different from the Robinhood investors see 5 years from now. And that possibility is exactly what attracts many growth investors. The market often rewards businesses that successfully expand their addressable market. Robinhood appears determined to do exactly that. At its core, this is a company benefiting from powerful secular trends: the rise of self-directed investing, the digitization of financial services, growing participation in financial markets, and increasing demand for mobile-first experiences. Those trends are unlikely to disappear anytime soon. That's why, despite recent weakness in the stock price, Robinhood remains one of the most intriguing growth stocks available today. It isn't the safest stock on this list. It isn't the cheapest stock on this list, but it may be one of the most interesting, because if the company succeeds in becoming the primary financial platform for millions of investors, the long-term upside could be substantial. And that's exactly why Robinhood Markets earns a spot among the best growth stocks to buy right now. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, when comparing the two stocks featured in this video, each offers something unique. Uber provides exposure to transportation, logistics, and future mobility trends. Robinhood provides exposure to digital finance and the next generation of investors. The two operate in enormous markets. The both possess recognizable brands, and they continue pursuing growth despite already achieving substantial scale. The market will always experience volatility. Headlines will always create uncertainty, but truly exceptional businesses have a habit of rewarding patient shareholders. Uber and Robinhood possess characteristics that growth investors should appreciate. Strong brands, large addressable markets, scalable business models, and management teams focused on expansion. Will the two outperform the market? Nobody knows for certain, but based on their fundamentals, growth opportunities, and competitive advantages, they deserve a place on every investor's watch list. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd love to hear from you. Which of these two businesses do you believe has the strongest long-term competitive advantage, Uber or Robinhood? And which one would you be most comfortable holding for the next 10 years? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.